Alrighty, folks, we got to talk about the Fed. The Fed will have a meeting in the middle of December, and the market's still about 50-50 on whether or not they're going to cut rates. But we're going to have a conversation with Taylor from Life Goal Investments, and I'm just going to be blunt. Why the hell is considering cutting rates? Inflation is up, PCE, PPI, CPI. The job market is strong. Why the hell are they talking about cutting rates, Taylor? I don't get it.
I don't think they're going to in December. Did I give it away too soon?
No, that's awesome. I've had so many people just like, it's going to happen. It's going to happen. It's going to happen. I'm like, no, why?
Yeah.
I can't cut rates. What are you talking about?
Yeah. I think they've left themselves an off-ramp with every single one of their meetings that is for this specific purpose. They have said until they were blue in the face or purple or whatever comes after that, we're going to leave ourselves data dependent. Well, it's hard to follow the data right now and say that, hey, we are due for an additional rate cut. And that comes to your point. Listen, like inflation is not moving in the right direction right now. And I'm not saying it's spiking. Don't get me wrong. No. It's still tame, right? It's still within the band of comfort by all means. But it was drifting downwards precipitously, and now it has begun to tread a little more water, if you will.
Yeah, I think when you look at the inflation picture, and again, as an economist, you can look at the base effect and you can prognosticate what's coming. And we have some pretty good months that really could take inflation sub 2%. It really could. I mean, if you look at the math. However, if they're really going to be data dependent, you got to look in the mirror today. And the last inflation readings are up. The trend is reversed. You know, at best, you could call it sticky. And you have an employment market that still has unemployment rate at 4.1%. We'll get a new number on Friday, but it's not going up, at least currently. So I don't get it. I don't get the talk and the nature that, a cut is coming in December. Obviously, we just talked about in the previous episode about Trump's impact on the economy. The Fed has to look at that, even though 100%. They don't want to talk about it, admit it that, 2 out of the 3 pillars we talked about are potentially inflationary. And they've got to keep, some ammunition in the gun, right? They can't just keep cutting. Cause I think the worst answer is, cut in December and, raise in March, for example. That'd be a disaster.
Totally agree. Yeah. And I think this is a little bit of probably an education for most folks. One of the things they talk about a lot is paying attention to the health of the financial markets. Mm-hmm. And so, I think financial markets can mean a very broad stroke. And a lot of people think, hey, it's the stock market. And by all means, the stock market is incredibly healthy right now from valuations, every way you look at it.
Some might call it richly valued. You call it healthy if you want.
Yeah. Really, really, really healthy. It's in Olympic form right now. But I think the other thing that's more interesting to look at, and probably what the Fed pays more attention to, are the bond side of the market. And so the way you look at the health of the bond market is you take the treasury rate and then you look at where corporations can issue debt above that. Right. And so they're looking at the spread. They call it credit spreads in nerd terms. So if you're an investment grade company right now, credit spreads are, say, the 10 years at 4.25, round numbers. Right. And then what they're going to do is they're going to apply a spread where if you're going to issue debt to Apple, Microsoft, a high quality company, how much more than the risk-free rate of the US Treasury are they paying? And right now on investment grade companies, credit spreads are right at about 70 basis points or 0.7%.
Wow.
In addition. So to give context, that is incredibly narrow.
Yeah, I was expecting to at least have a one handle.
Yeah, no, it doesn't. And this is the thinnest credit spreads have been since the mid-90s. So that tells you a couple things. That tells you the markets are healthy. The market is pricing far from any recession being exposed anytime soon. And then you can also look at, it's not just investment grade companies, but it's also junk companies or high yield companies. High yield spreads right now are also at mid-90s lows. And so again, if you're able to, as a company, go out and access debt at an incredibly low rate, that means money's really cheap to these companies. And all of a sudden, financial markets are really, really healthy.
Yeah, it's really funny. One of the things that I've been looking at and talking about for well over a year is for a long time, the big got bigger. And obviously I talk real estate. So the only people really going on a building spree were the publicly traded builders, right? Because they have stock and they can issue bonds and keep the party going. if you were a small and medium-sized builder who had to go to a community bank, First Republic's, Silicon Valley Bank, right? Those commercial banks, lending was off.
Correct.
Right. And we've seen a bunch of acquisitions. So if we take that to what seems to be happening now and projecting into 2025, the lending environment is getting better, right? If the spread is that low, you're going to see a lot of, the Russell 2000 and companies that were maybe balance sheet broken look a little bit better, right? Because they couldn't refi debt or restructure debt, but maybe now they can. So
yes and no. So I'll say this, that when you look at just the banking kind of industry at large, they just got slapped in the hand pretty badly. When Silicon Valley Bank blew up, the government stepped in and the Fed stepped in and said, guys, like you can't do this.
Yeah, you can't do this.
When people deposit money, guess what? When they ask for it back, they expect you to be able to give it to them. Exactly. And a lot of it wasn't a function of bad loans they were making. It was a function of the loan's maturity didn't align, the liquidity didn't align with the needs of the consumer. And so what happened there was a lot of these banks stopped being able to issue debt to that middle market person. Yep. And correct. So you did see a little credit tightening. And if you look at, and you see it more so in your world, but I track this data as well. If you look at particularly commercial starts and builds have literally just absolutely plummeted. And listen, this is natural. If the cost of financing went up over the last 18 months from 0 to 5.5, and then you put your spread on top of that, so all of a sudden, investment property loans for these big corporations are going off at 8, 9, 10%. And then you put on the fact that materials have materially gone higher. And then also labor costs, right? So every input cost they have just skyrocketed, and that brought a dearth of new product to the market. And we'll see. But I do think, some of the deregulation that has been spoken about will certainly help that area of the market.
Yeah. No, I think I think just generally speaking, I'm seeing behavior change at kind of the small and medium-sized companies. Again, I think there was a survey last week, CNBC survey, small business survey, that, just in a month went from a 52 to a 63, right? An 11-point move. Small business is just more interested. Now, maybe that's hopium, who knows? But I do think people are more interested in investing. And again, if the cost of capital is lower, that only helps with that.
Well, I take this for what's worth.
Yep.
But I cannot say something that might be deemed as bad on social media right now about Trump's policy. Like an honest take. I'm not trying to be an ass. I'm trying to give like the honest, here's the goods, here's the bads. The goods go over swimmingly well. The bads, regardless of whether they're an honest take or not, without getting absolutely tarred and feathered. And so that is clearly indicative of like, there is huge, and maybe you say that our following leans right, and that's possible as well. I don't know the answer there, but there is huge overwhelming support beneath the surface, I think, for this administration.
Oh, I mean, you could see it in the numbers. I think there was a survey that was released Friday. Again, it was the same survey, small and medium-sized businesses. Again, I talked about going from 52 to 63. If you delineated that Democrat versus Republican, it was something like Republicans were an 84 and Democrats were like a 37 or something.
Yeah.
Right. Something wild.
I even saw initial spending. This is crazy because I didn't realize it would go this far. Initial spending for holidays broken out by states that went Republican versus went Democrat.
I saw that too.
Like a landslide, more spending. I'm like, whoa! I didn't realize it would leak through that much into people's psyche that they are able to now afford more. Or, this person that came into office, I hate him, and now I can't buy, holiday gifts for my loved ones.
So it's really funny. So I actually saw that report. It was wild to see just red and blue. Like I think the title of the article was like, Republicans to keep us out of recession, or just something like that, because they're spending. So I don't think it's an afford. I disagree with that. It's not like I can afford. I think what it is hope for the future, because the consumer psyche is it's repeatable. If you are happy or hopeful for the future, you spend. If you are fearful and concerned, you conserve. So that's all that happened.
Totally.
Is one side of the house is afraid, and the other happy is like, hey, time to party. It's 2000.
Counterpunch. I will, and I totally agree with your comment, but now I'm just being a wise ass. Maybe now some of them can afford based on where the market went in short order.
Yeah, the wealth effect is real.
Leaked quickly.
Yeah, very, very cool. Well, let's talk about the Fed a little bit more. So I think we both agree that a December rate cut, I'll say it's not warranted. Who knows if it'll happen, if it's priced in, yada, yada, yada. But I want to talk about 2025.
Okay.
I had a really controversial take about 6 weeks ago, and this was pre-election. At that time, I'm like, okay, you're going to get the December rate cut. You're going to get your 100 basis points. But back to my higher for longer, I said, be prepared for a minimum of no cuts in Q1, Q2, and possibly no cuts in 25. What do you think of that?
I think that they're still infatuated with this fictitious thought of this neutral rate.
Yeah.
And this neutral rate is something that no one knows what it is. It had been floated and then somehow has been kept up along the way. Essentially, what they're saying is there is a certain amount of spread between where the federal funds rate is and where inflation is. And if that spread is too wide, you are incredibly restrictive with your policy and the economy will slow. Well, that spread is pretty darn wide right now, and the economy is humming. So I'm kind of with you. I don't really care about what the neutral rate is historically or has driven looser or, tighter monetary, like that should not be the impact. We should look at the data, look at the trajectory, and a lot of the trajectory can be at least gleaned off of the stock market, but more importantly, the credit spreads that I talked about before show that things are going to continue to be healthy because these bonds that are issued, they're not 6-month bonds. Yeah. They're longer term bonds than that. And if we're willing to issue longer term bonds and say the risk is de minimis for investment grade and junk companies, what's it going to take to, massively reverse that?
Yeah. I want to give a shout out to Michelle Bowman. I mean, Michelle Bowman was obviously the Fed president who declined to vote for a 50 basis point cut, their first rate cut. And really her logic was that she disagreed with the other 18 voting members on what the neutral rate was. At the time, most people thought it had a 3 handle. She proposed it had a 4 handle. And what I've seen over the last 4 weeks or so is more and more people are starting to talk about this R-star neutral rate, whatever you want to call it, having a 4 handle, which means, oh, by the way, we're close because as of today, we're at 4 3/4.
Right. I tend to agree with you and don't think that your comments are crazy. If inflation continues to be sticky and depending on how quickly economic policy comes to fruition, then that's certainly a concern on, hey, can inflation pick up more quickly? And I heard a great podcast who this guy was like the biggest Trump bull of all time. And he had all the data to back it, but he said that, listen, Reagan. So the biggest mistake that Reagan made when he came into office and cut taxes was he cut them slowly. And he said that he doesn't think Trump will do that. He said he thinks they will cut them swiftly and enact that tax cut immediately. In the fact that what companies do if they know that taxes are going to be cheaper in the future is they just don't spend. And so it caused the recession right on the onset of that Reagan tax cut announcement, which is counterintuitive. But when you think about it, why would you spend right now if you know you're going to pay less in taxes 2 years from now?
No, absolutely. I got a crazy idea. It just jumped in my head. One of the things they could do with tax cut is they can actually make it retroactive, right? Obviously, Trump will come in the 20th of January, 2025. But I have no idea if anybody's talking about this. But my thought was, what the heck? Why don't we make it retroactive to 2024?
Well, but that's So that is definitely the school of thought on that. I have heard a couple people comment on that. I'll just say, kind of counterpoint, if you're thinking about what I just stated, that doesn't do anything for that scenario because people can't retroactively go back and spend. You know what I'm saying? Go ahead.
No, but they would have theoretically put aside tax dollars that they don't need to spend that then could be spent immediately.
Didn't think of that. Well put. Boom! Again, I'll take your counter punch.
Got him. Standing 8 count. No, but again, if you go back to the Reagan thought track, that would be like rocket fuel.
Yes. Yes, it would. If we went back and said, hey, it was going to be a 25% tax rate, now it's going to be a 24 or a 21% tax rate or whatever's been proposed.
Yeah, I mean, let's just
tax,
use real
5%
numbers
tax.
instead of percentages. You were getting ready to write $1 million check. Now you're going to write a $750K check. That's $250,000 sitting there ready to be deployed.
Let's go, baby. Let's go.
There you go, folks. Let's make it retroactive to 2024. That'll be exciting. Oh my goodness.
I think all in all, when it comes to the Fed, I'm with you that cuts are going to be slow and more calculated moving forward, with inflation just having gotten stickier and the economic backdrop having shifted.
So what do you think? No rate cuts. So no December, no rate cuts through June. Odds, 0 to 100%.
I think that's a very bold statement. So I don't think the odds are incredibly high. I'll put it at a 20% chance, something like that. But the futures markets for rate hike expectations, they change dramatically. So right now that looks like a far-fetched thought, but given the actual logic behind it, it's not all that crazy.
How about one rate cut between now and June?
I think that's not unlikely. I think highest probability is probably 2. The Fed is they're so methodical, and they have started this path, and they don't want to look bad and all that. So, but no, I'm with you. I don't think it's needed.
Yeah. Well, how many rate cuts in the next 13 months? So we'll include December. So the remainder of 24 and all of 25.
Yeah. So maybe it comes down to 4%. So it would be 3 cuts, 325 basis point cuts.
All right, folks, let me know in the comments below. How many rate cuts do you see coming? The answers are going to be 0, 1, 2, or 3, or pick another number. Let us know in the comments before. Taylor, where can people find you?
Yeah, find us on Instagram and on TikTok every day, putting out information at Life Goal Investments, 60-second clips. Go to our website, lifegoalwealthadvisors.com.
Awesome. Thank you very much.
Thank you.